So, in this second part of our three-part series on oil in the Middle East, I want to talk a little bit about the resource curse. Now, one way to understand the resource curse, and the way it was probably understood until about 1990, was as primarily an economic challenge. Even as early as 1970, there were questions about how much of a blessing oil would be to the Middle East. One Saudi oil minister called oil the devil's excrement and wished that they would have found water, not oil. Economists have understood for a long time that rapid influxes of income are not unmitigated benefits for a country. You can point to the Dutch tulip craze of the 1700s and the Spanish conquest of America, which brought lots of gold and silver into the Spanish and the European monetary system, as examples of badly handled resource booms that caused a lot of disruptions and that caused a lot of misery, even as they made some people fantastically wealthy. So three sources of problems that I want to discuss, and these are three economic sources of problems. I will talk about political problems in a subsequent lecture. Price volatility, Dutch disease, and export dependence. Price volatility. The price of oil can fluctuate wildly depending on supply and demand conditions. In 1999, for example, it was $15 a barrel, way up to July 2008 when it was $145 a barrel. That's nearly a 1,000% increase. Today, it's about $41 a barrel, but the future is completely radically uncertain as to about where oil prices are going. If you're Saudi Arabia and you produce 10 million barrels of oil per day, then you could be making anywhere from 150 million to 1.5 billion dollars per day in revenue on the open market. That's a huge gap. This creates several challenges for governments who need to be able to plan their expenditures for the future. So, should you make healthcare free? Should you increase Social Security or retirement benefits? All of these questions are important questions that governments across the world may end up facing, but it's a lot easier to make these decisions if you have some idea of what your revenue is going to be next year. If your revenue could literally drop 1,000% year on year, 1,000% is not ever going to happen, but if it could drop 200 or 300% year on year, and that certainly could happen, that makes it difficult to make these sorts of decisions. In the United States, GDP changes maybe 0 to 3% per year. So even if the economy goes up or the economy goes down, the government's revenue is pretty predictable, or relatively so. Saudi Arabia's revenue, like we said, could change several hundred percentage points year on year. That makes it very difficult to make important fiscal decisions. Another challenge brought about by price volatility is inflation. If people have a lot of money to spend, this means that they're all competing for a relatively fixed, at least in the short term, supply of goods, services, labor, and capital. The price of everything is going to go up when large influxes of money come into the economy. And so if the price of your currency, like the rial in Saudi Arabia, is allowed to float, and by the way, it's not, then the price of a haircut or hiring a day laborer could also fluctuate wildly from week to week. These are not ideal business conditions for either investors or for consumers. Ideally, you want to be able to predict your return on investment if you're an investor, and currency volatility makes that very, very difficult. Foreign investors do not like investing in unstable economies, and domestic investors might prefer to bank offshore to export all of their money elsewhere than invest it in the local economy. Now, obviously, the lure of big potential profits will attract some businesses, but the risk is going to be also fairly high, and that might turn off especially more reputable investors who will prefer those kinds of emerging markets that promise a more stable return on investment. Now, there's a fairly well-documented link between exchange rate volatility and slow economic growth, so this should not be a surprise. And to the extent that oil prices are a driver of exchange rate volatility, then that can be a big issue. A second issue that is related to the first is called Dutch disease. Now, Dutch disease sounds like a strange affliction that you might get while visiting Holland, but Dutch disease actually is simply named after what happened in the Netherlands when oil was discovered in the North Sea in the 1970s. And Dutch disease operates by two mechanisms, right? So it's an economic affliction, something that affects economies, that has two mutually reinforcing issues, a macroeconomic and a microeconomic problem. The microeconomic problem or microeconomic effect is domestic inflation, which we just talked about. As revenue flows into the economy, everything gets more expensive, especially capital and labor. So the interest on loans gets more expensive if you're going to the bank, and the price of hiring workers gets more expensive. So for example, lots of money comes in and you need to build new facilities for oil extraction. You're going to have to pay construction workers more than what they could get elsewhere to attract them to your new construction project related to the oil discovery. What that means, in effect, is that if other sectors of the economy want to retain those laborers, they're going to have to pay them at least as much, which causes a kind of price war between different sectors of the economy over a limited source of labor. Now, so what happens when capital and labor gets more expensive is that the prices go up across the economy, which means the production costs, the cost of goods that are not oil, goes up. Manufacturing goods, agriculture goods, all of these types of products that an economy might have been producing prior to the discovery of oil suddenly become more expensive to produce. Your costs have gone up. The cost of accessing capital went up. The cost of getting a loan, in other words, and the cost of hiring workers has gone up. And this is a problem specifically for the export sector, since the country's exports are now more expensive relative to other countries' exports. Or if you're competing against other countries, if you're making, I don't know, steel or wheat, you're exporting wheat. Well, if your wheat gets more expensive because your costs just got more expensive, that means you're going to sell less wheat on the international market. The demand for wheat from your country is going to go down, which means you're going to sell less wheat. Or if you sell the same amount of wheat, you're going to sell it for a lower price, all of which means that you're going to be making less money. And so as a result, the country's exports are now less competitive. The macroeconomic effect is something to do with the currency appreciation. That is to say, the value of your currency relative to other currencies. That is to say, the price of a real relative to the dollar, right? What happens is that when a lot of oil floods a country, the demand for that country's currency increases because you have to pay domestic producers in the local currency. If you're a Saudi Arabian and a Chinese businessman wants to buy your oil, you don't want to get paid in yuans, right? You don't want to get paid in the Chinese currency. You want to get paid in your local currency, which you can actually buy stuff in. And so the demand, so money changers are going to have to give out a lot of reals, which creates an increase in demand for reals. What that means is the real gets more expensive because more people are competing to get reals. There's an increase in the value of the currency relative to other currencies when oil is discovered. This makes exports more expensive for other countries to buy, and thus domestic exports are less competitive. Again, double whammy, right? Not only have your costs gone up, but now the apparent price of your goods relative to other countries' goods is also higher because your currency is more expensive. This is a double whammy for non-oil exports of a country where oil was just discovered. And this, by the way, applies to oil as much as it applies to natural gas or any other a gold mine, copper, anything that would cause both domestic inflation and an inflation of the currency. So what this means, right? Okay, I went through kind of a technical description of what these things are economically, but overall, the takeaway point here is a Dutch disease means that a country finds it very difficult to keep its other export sectors competitive when it's exporting a lot of oil, because the costs and uncertainties of producing goods for exports in the resource-rich country are now higher than they were before, right? So as oil exports go up, other exports like agricultural exports and light manufacturers go down. They're less competitive. They cost more to produce in that country, and the currency is running the wrong way as exchange is too high. So over time, what we see is the agricultural and manufacturing sectors of oil-rich countries, we see them decline. And we can observe this in all oil-rich countries. This leads us to our final problem, export dependence. As other industries decline, the share of gross domestic product and the share of government revenue made up by oil sales rises. Right? So it used to be perhaps that 20% of your budget or your GDP was oil. Now it's 80%. Right? Now this has problematic consequences. It makes volatility worse, right? Since now more of the economy, a greater percentage of the economy, is tied to a sector that's very volatile. So, you know, your government revenue, which, you know, if it's 80% determined by the price of oil and how much oil you sell, well, you know, depending on what the price of oil does on the international market, over which you have no control, depending on the price of oil, you could face big swings in revenue, larger than if your economy was more diversified. If only 20% of your revenue is oil, well, you still have 80% that's something else. And so it's going to produce less big swings in your year-to-year operating budget. Now, since most of the country now is seeing its revenue coming from outside the country, that makes it very vulnerable to slowdowns in the world economy, and therefore makes that country much more economically and politically dependent on the goodwill of other countries. So oil-rich Arab states have to maintain much friendlier relations with Europe, Japan, and the US than non-oil-rich countries. Why? Because these are the major oil export markets, and we can add China to this list of countries today. China is extremely oil-hungry. Oil-rich states, in other words, have a continued vested interest in the health of Western economies, because the health of Western economies and the growth of those economies is what drives demand for their main export, oil. Now, this is a source of vexation for lots of people in the Middle East who see their governments cozying up to the West, that see their governments apparently in a subservient relationship to the West because of this economic imperative to maintain good ties to the West. And yet this imperative seems inevitable in a way. It's not clear what it would mean to try to become independent, what it would mean for a country to try to pursue a strategy of growth that didn't depend on oil. Those countries would become vastly poorer very quickly. So, briefly summing up this economic problem, the combination of price and revenue volatility, domestic inflationary pressures through Dutch disease, and ultimately export dependence constitute the main economic and policy challenges for oil economies in the Middle East and all over the world. So, we've mentioned the problems. I want to spend at least a little bit of time talking about the solutions. What are some policy solutions that Middle Eastern countries have come up with to deal with these economic challenges? It's not as though these challenges are unknown. I'm going to discuss 5. OPEC, leaving oil in the ground, financial markets, natural resource funds, NRFs, and exchange rate controls, and maintaining foreign reserves of currency. Let's talk about OPEC. OPEC is the Organization of Petroleum Exporting Countries. OPEC is a producer cartel that regulates the price of oil by preventing the major oil producers in the world from releasing too much oil in the market. Basically, it prevents oil-producing countries from competing too hard against one another by releasing too much oil into the market, which would drive down the price for everyone. So OPEC is a way of trying to monopolize the market and bring oil prices above their competitive market clearing price. How does OPEC help? Well, one way that OPEC helps all of this is by keeping the price of oil more stable, at least in theory. Right? In theory, by stabilizing the oil price, OPEC can help governments avoid the evils of price volatility. However, in reality, since it was created in 1960, OPEC itself engineered 2 massive price increases in 1973 and 1979, and it could not prevent subsequent sharp declines in oil prices afterwards. Moreover, OPEC has seen its member countries have a declining share of oil production since 1960s, with large producers emerging outside OPEC and basically making it much more difficult for OPEC to control oil prices. Canada, the United States, Mexico, Brazil, China, and Russia are all expanding oil production, and none of them are members of OPEC. A second solution might be a simple solution, although politically quite challenging, which is to leave the oil in the ground. right? All of these effects only occur if you're extracting oil from the ground. There is, of course, tremendous pressure to raise revenue, spend money, alleviate poverty in all of these oil-rich countries. But there's nothing wrong with leaving it in the ground. It's not going anywhere, and chances are, because it's a non-renewable resource, it will probably be in demand later as well as now. Of course, if there's less inflation, you'll see less volatility, which means less pressure on domestic non-oil industries, which means less export dependence. All of these things could be good for a country. Granted, it's not as sexy as being able to get a lot of money fast, but it has the compensating advantage of not wrecking other sectors of the economy. Financial markets. Financial markets are another way to avoid revenue volatility by simply selling today oil that hasn't been extracted from the ground yet. What you essentially do is either sell the rights to extract oil in the future, or simply agree to an advance price at which you will sell your oil in the future. Again, you can achieve this through Western financial markets, through dealing with Western companies as well who might be willing to take these contracts. This can stabilize your oil revenue by letting you know in advance what you're going to get for oil in the future. What you're essentially doing is you're offloading the downside and the upside of price fluctuations on other people. So a smart investor might be able to make money because the oil price goes up, but a bad investor could lose a lot of money by having to give you a lot of money, even though the oil that they're going to be able to sell is only going to be able to be sold at a lower price than the one that they paid for it. So these contracts tend to look very good for oil-producing countries when oil prices go down, but they often look very bad when oil prices rocket upwards, right? So although this deals with volatility, this doesn't necessarily deal with the price inflation or the export dependence that can result from this regular stream of revenue coming into the economy, but it certainly deals with the ills of volatility, and that's already something. Let's talk about NRFs. Another way to prevent Dutch disease entirely, prevent the money from coming into the economy entirely, is to put the money the revenue from oil sales into something called a natural resource fund, also sometimes called a sovereign wealth fund. What you simply do is you take all the oil sales and all the money you get from oil sales and invest them in financial instruments outside your country. So foreign government bonds, foreign stocks, foreign real estate. The point is you don't let the money come into your economy directly. You buy up assets and hold them like savings in a savings account. And then you dictate at what pace those assets are going to be liquidated and introduced into your local economy. Right? You're basically insulating the local economy from excess resources by basically taking all the surplus revenue that you don't need for your current expenditures, putting it in a giant savings account, and saving it for a rainy day, perhaps for days when the price of oil will go down, and you will then need to drain some of your savings account in order to meet current expenditures. So you can avoid volatility, you can avoid Dutch disease, and you can ideally avoid export dependence, all by simply refusing to massively introduce the revenue from your oil sales into the economy. So NRFs have been successful. Norway has a massive NRF these days, and other countries have emulated Norway in creating big natural resource funds. But the problem is that these natural resource funds face huge political pressures from domestic interests who really want more money to come into the economy now for urgent priorities. And so the pressure is always to raid these sovereign wealth funds and spend the money now rather than save it for a rainy day when perhaps oil prices will plummet and you will need the money. Okay, I think this is our last one, which is exchange rate manipulations. Rather than require that foreigners buy oil in domestic currency, the government could try to sell its oil when it owns the oil for dollars or euros or yen or some currency that's not domestic currency as a way of insulating the domestic economy from inflationary effects. Of course, if you're buying technology from these countries, it makes it easier to buy that technology to develop your domestic economy, since the exchange rate is now taken out of the equation. Now, to be sure of controlling this process, it's much easier in this scenario if the government is selling the oil itself, right? If the government has no control over, say, what a private company is doing and what currency the private company is conducting its transactions in, then this solution doesn't work. So this works best when there's a national oil company that sells all of the oil from a country, and the government can therefore control what currency that gets sold in. Right. So, and if the government wants to spend money locally, it can also decide what exchange rate it's going to exchange the money at. Basically, it's deciding what domestic prices are going to be, and what the domestic price level is going to be, and rather than having to face pressure by the market as to what the exchange rate will be. So, I'm sorry if that was a little bit lengthy, but all of these strategies are fairly economically sound, but they all face political challenges. What's optimal in economic theory may not always be politically feasible or stable given the distribution of domestic and international political interests. In the next video, we're going to examine some of the political challenges of managing resource wealth, and I think one thing that we can retain from our examination of the so-called natural resource curse is that oftentimes the best political solution is not identical to the best economic solution, and so you face a dilemma when you're a policymaker operating in a resource-rich economy.